Netflix just reported their second quarter earnings, and they have always been sort of like a canary in a coal mine, giving us a sensing of what to expect in the upcoming big tech earnings. Now, I think it's more important for us to understand what to expect in these upcoming earnings because stocks actually just recorded their worst week since April. And there are basically two camps here. Some believe that this is a healthy correction and just a normal rotation into small cap. However, if you look at the indexes, the IWM actually fell for 3 straight days to close the week out. We really are on the fence right now, and a strong earnings seasons, of course, could see stocks rebound from these levels over here. However, a weak earnings season could actually signal more pain to come in the market. Hence, that is why we need to understand why Netflix fell by 6% when they first released earnings before rebounding back during the earnings call. You see, Netflix actually fell on lower guidance in Q3. However, during the earnings call, I believe their share price started to bounce back because people started to understand that they're actually projecting out a stronger finish to the year. I believe this was actually a fairly good quarter for Netflix, and actually raising the full year's guidance despite a lower Q3 expectation kind of eased people's fears. Year to date, Netflix has been up about 30%, and if you go all the way back to last July, Netflix actually is up about 47%. However, in the past week, it's sold off by about 10% as tech continues to sell off, and so let's dive deeper into the earnings. I think if you look at the numbers, right, overall Netflix had quite a decent earnings report. Like, they basically beat expectations across the board, except for guidance, which we will talk about it later. And their ad-supported tier grew by about 34%. So basically, on a very high level, their revenue was 9.56 billion in the current quarter compared to 9.53 billion expected. Earnings per share $4.88 versus $4.74. And I think the most impressive one is the change in subscriber count, net change in subscriber count of 8.05 million compared to expected 4.87 million. So basically, they currently stand at about over 277 million subscribers. You consider the fact that Netflix actually has a TAM of about 6 to 700 million households, then they're about 1/3 of the way there. That's not to say that they can capture the whole market, but they obviously still have room to grow. And then I think we get to the part of the earnings report that spooked investors initially, which is the Q3 guidance. Basically, they guided for 9.73 billion in revenue versus 9.83 billion. And if you have to put it in perspective, right, because I don't own any Netflix shares, so just basically as an outsider, looking in objectively, I would think that that's not such a big deal because it's basically a change in about 1% in terms of revenue. However, overall, their full year guidance raised to 14 to 15% from the previous 13 to 15%, which means that they actually increased the lower end of their guidance. Like, although it's marginal improvement, it's still an improvement. But what I really like is that they actually continue to guide for margin expansion. They said that their operating margin will be expected to be about 26%, up from the previous 25%. So I believe if you take the Q3 guidance just by itself, it may seem a little bit worrying because you don't know what's going to happen moving forward. However, if you take into context the full year, that's like saying this quarter I may be making a little bit lesser, but overall for the next half of the year, I'm going to be making more than you expected. So to me, that's not a very scary thing, and that's why I think the stock actually rebounded after the earnings call. And also, I think if you were to consider Netflix venturing into sports, things like signing a deal with WWE, I think Monday Night Raw will be on Netflix, as well as the NFL season. I think now it's kicking off. I don't profess to watch NFL. I watch soccer, not football, or football. Not, I don't know. I watch the round one. Okay, I watch the round one, and then basically I think that from what I know, the preseason is kicking off now. More viewers will be on the platform. More people are likely to maybe renew their subscription or start subscribing just to watch this new season, because I know NFL is actually pretty big in the US, and in the US side, basically the customers actually generate a higher revenue per member. So hopefully that will start to increase. And secondly, I think the ads business is doing well. We can see from the increase in number of the ad-supported tier subscribers, but I think it's still to be seen on how much revenue these advertisements can really generate for them. And so if we take a deeper dive into revenue, we can actually see that Netflix revenue was up 16.7% year over year from 8.1 billion last year to 9.56 billion this year. And I think what makes Netflix interesting and attractive as a company is that when you look at how they operate their business, their marketing spend is only up 2%. So if you consider you actually spend 2% more for marketing, but you get so much more members compared to last year, I think that's a sign of a pretty strong company and a good marketing spend. And I think with the R&D up 8% and the SG&A only up 6%, it shows that they are actually being wise in the way that they manage their money. And so actually that means that at the end of the day, we can actually see that Netflix operating income increased and their margins actually expanded, having a 27.2% margin this quarter compared to 22% a year ago, which means that for every $100 that Netflix make this year, they get to keep $5.20 more. Now, earlier on, I was talking about how the NFL season, the restarting of the NFL season and the signing of the deal with Monday Night Raw can actually drive more US customers back to the platform, because some people are seasonal subscribers, means I subscribe for a few months just to watch the sporting events and then I unsubscribe when I don't watch it. And I hope that this actually drives more users back to the platform, because if you look at this breakdown over here, you can see that the US and Canada Netflix users basically generated a higher average revenue per member, like our ARM in this case. If you look at the breakdown for Europe, which is the second component over here, you can see that in terms of net additions, slowed down quite a bit compared to last year, where you actually see about 4 million or even 5 million towards the end of last year per quarter, but now you're actually only at 2.2 million, which is the slowest, even slower than compared to 1 year ago. So the growth here is actually slowing down. However, the average revenue here per member maintains steady. And so if you look at the other regions that Netflix are serving in Latin America, their paid net additions is up 1.53 compared to a year ago. However, it's down quite significantly quarter over quarter. And I think what is concerning here is that the average revenue per member continues to decrease. Now it's basically at $8.28, the lowest that it has been. So whether or not they can continue to increase the average revenue per member in this area is also remains to be seen. I think also because of the demographics of this area. Basically, after looking at these two slides, I think what jumps to the front of my mind is basically their marketing costs. I'm quite glad to see that their marketing is actually only increased 2% over the last year. However, I think how they allocate their marketing dollars is very important, because if you actually look at the breakdown in terms of average revenue per member, the amount that you spend to acquire a US customer cannot be the same as the amount that you spend to acquire an Asian or even Latin American customer, because of the difference in average revenue per member. So basically, every member that you acquire, the cost that it takes you to acquire a US-based member will earn your business $17 for every new person that you onboard. However, in Asia and Latin America, basically every customer that you acquire basically only earns your business $7 to $8. So imagine if you spend the same amount of money to acquire a US-based customer as compared to a Latin American and Asian-based customer, and then what happens is that you're basically compressing your margin moving into the future. But so far, management seems to be handling it well, especially with the ad-based here. So I think we have to pay attention to this moving forward. And it's not something I'm concerned about. This is just something that jumps to mind when I look at the numbers. Because overall, right, I think their revenue growth is fairly decent for a mature company. I like the expanding margins, especially if you compare it to other streaming services. I think I just want to show you this Disney Plus one. When you take a look at the breakdown for Disney Plus, right, they're barely break even, and other streaming companies are not even break even. So Netflix really has the lead here. And granted, if you just compare solely to Disney Plus, I know Disney have other sources of income, but I think I'll touch on this a bit later on, because Netflix also are building out other sources of income. So overall, if you look at Netflix, their average revenue per member or ARM is only up 1%, while their subscriber growth is up 16%. So of course, if you're bullish on Netflix, this is a good thing, right? Subscriber growth up 16%. So you're getting subscribers, you're increasing your revenue. However, if you're bearish on Netflix, I know some people are actually saying that, hey, every subscriber you're getting is actually earning you less money. So potentially that signals a slowdown in revenue. And if basically they can't cut costs as fast, then we can actually see some margin compression. So that's something that we need to keep an eye on. But to be very frank, management has been managing the company quite well. They haven't given me any reasons for concern, and they're actually building up other revenue drivers like their ads platform and things like that, which I will talk about later on. So right now we're going to move on to the balance sheet. If we were to look at their balance sheet, Netflix actually has about $6.6 billion in cash, $2.9 billion in other assets. So basically their total current assets stand at about $9.6 billion. And if you look at the debt that they owe, short-term debt $1.8 billion, not a problem. They can pay that off immediately. Long-term debt $12 billion. Now it may look like, hey, how come I got more debt than actual cash? But because this is long-term debt, I'm really not too worried. And considering that every year they're generating at about $6 billion free cash flow, so basically if they want to, they can pay off all their debt this year with their cash and free cash flow. So more importantly, because their short-term debt is only $1.8 billion, like I was mentioning earlier, it's still well within comfortable levels. And the next thing we want to look at is operating cash flow. So basically operating cash flow last quarter was $2.2 billion. This quarter is only $1.3 billion. So I think that was something that actually stood out to me that I was quite concerned about. So when I went to dig a little bit deeper, right, I actually realized that June always seems to be the lowest. Why is it I always pronounce something wrong in every single video? Lowest. But anyway, June always seems to be the lowest cash from operation. It was the same for 2023, 2022. So it could just be a seasonality from business. When I look at the transcript, I don't really see anything. It just says that, oh, we are on expectation to basically generate $6 billion in free cash flow, which is what they have guided so far. So year to date, we have generated about $3.4 billion in free cash flow. So we expect another $2.6 billion in the second half of 2024. Why is it lower in the second half compared to the first half? I would think in large part due to the money that they are pumping out into generating content, because every single year they actually spend about 16 to 17 billion to create content, new shows and things like that. So basically, when management guided 17 billion to content in 2024, so far they only spent about 7 billion. So that means I think if you project out for the rest of the year, they have another $10 billion to go. And they are using their free cash flow to purchase shares, which actually will increase their earnings per share, which is something that I like to see as well in a mature company. When you look at the capex spent by Netflix, actually it's not very high compared to the amount of cash that they generate. So they actually have quite a significant free cash flow, which is why I think they're quite confident when they actually project out 6 billion of free cash flow. And I think this is something that we hope to see increase over the years. Whether or not they will need to spend more to generate content, I really don't know in future. but I think this is something that we will keep an eye on moving forward. You see, basically, I'm not a show-watching person, and Netflix was the one that got away, because back in the day, I decided against investing in Netflix, not because I don't think that they are able to create good shows, and fundamentally because I think, to me, Disney had the IP, and being a Marvel fanboy, right, I that was where I was leaning towards. Honestly, I didn't expect Disney to make such a mess of their business, and quite thankful I actually didn't invest in them for other reasons, but I really didn't expect them to make such a mess of their business. But Netflix really earned my respect for their execution, and like I said, I'm a sucker for good management and good execution. So I really like shows like Wednesday, Night Agent, and things like that, and they got me watching to the end of the series, which is really quite a hard thing to do. Earlier on, when I was mentioning how their new subscribers had some of the bears concern about Netflix because the new subscribers that they're actually onboarding onto their platform generate lower revenue per member compared to their US and European-based customers, right? However, I think I'm not too worried because, like I said, ads will become a part of their revenue moving forward. So that's what I want to talk about here. So basically, if you look at the earnings transcript, they actually say that given this sustained progress, we believe that we are on track to achieve critical ad subscriber scale for advertisers and in our ad countries in 2025, creating a strong base from which we can further increase our ad membership in 2026 and beyond. And I think what management is basically telling us is that in 2024, 2025, these are transitional years, and basically ads will only become a greater revenue driver in 2026 and beyond. So that is something that I'll definitely be looking forward to. And if you look at the second part of this this earnings transcript, they actually say we don't expect advertising to be a primary driver of revenue growth in 2024 and 2025, right? Which is basically what I said. The near-term challenge and medium-term opportunity is that we are scaling faster than our ability to monetize our growing ads inventory. So which means that their business is actually growing faster than what they can handle, which is a good thing, which means we can expect more revenue from advertisements in the coming quarters ahead. I've always been comparing Disney Plus to Netflix, and I think it's quite interesting that Netflix has planned for a Netflix house, which is what I was mentioning earlier on in terms of their other revenue drivers, right? So some people say that it's basically their way to compete with Disneyland. I don't think it is that close to being able to compete to Disneyland because the scale of Disneyland, the number of parks that they have, and the scale that they actually build it out to really is something. It's really something that not many other companies can do, and they have such a head start on Netflix. So I think a Netflix house with this kind of thematic rides or thematic attractions, in a sense, basically will be a good revenue driver for Netflix. How profitable it is, I am not very sure, because from what I know, if you just look at the parks and attractions from Disney, that's only about a 20% profit margin, which is lower than their current profit margin, although not much lower in a sense. So when you combine these two businesses together, whether or not it will affect their margin, I'm not too sure. However, of course, if their subscribers continue to be saturated and this is somewhat successful, then it can be another good revenue driver. Netflix games is another part of their revenue driver. Honestly, I was surprised to see Football Manager there. But I don't know how attractive this is going to be. I'm not really a mobile games person. I'm more of a console guy. So if you don't like Netflix games, right, you should actually let me know down below. But their management say that people like games that are related to the series, which I can see that is true, like what I said with the Netflix house, right? Because certain Netflix shows basically set certain social trends. Queen's Gambit, like I said, people play more chess. So if you have certain Netflix shows that are good, you come up with a similar game, people will generally want to play the game. But there is no longevity in that, you see. I would want to see if they actually are taking this game segment seriously, to have games that are basically more longer term and they can engage people that are outside of the show. So basically reaching a completely new audience. However, they don't really talk much about that. I think that's something that they're trying. Whether or not they are continue to grow this segment, how fast they're going to continue to grow this segment really remains to be seen. And that is something that we'll pay attention to. So if we were to look at the valuation of Netflix, right, currently they're trading at about 7 times EV to sales, PE ratio of about 39 times trailing 12 months, and about 33 times forward PE. So basically, if you compare this to the indexes on the NASDAQ, basically now the average PE ratio in the NASDAQ is about 33 times. S&P is closer to about 28 times. So if you go on this basis, then they do look a little bit overvalued. But I don't like just following the average of the index, which I know a lot of people usually do that, because I think sometimes companies do command a higher multiple for certain reasons, which is why the market actually tends to give them a premium, which is basically growth potential. And here, basically at these prices, the risk to reward for me, I don't know whether I would call this super attractive. You see, because Netflix is a fairly mature company, right? They are growing their revenue at mid-teens, and to pay 39 times earnings for mid-teens growth, free cash flow yield of actually only 2%, because they made about 6 billion per year, isn't super exciting. I think especially if you consider that the market is really teetering on the edge, there could be a collapse anytime soon if earnings don't go well. I think that you might want to hold back from actually opening a position right now. So if you already have a position, great. I'm not saying you need to sell, but whether or not I want to start a position here remains to be seen. I think there are other companies with better valuation right now that actually give me a better risk to reward lah. And I can actually see that if we pull back in the market, which actually the Nasdaq actually pulled back about 5% so far, won't be surprised to see it drop at another 5% to about 450. So when the Nasdaq does drop another 450, or if it does drop another 5% to 450, I think there will be better deals to actually deploy my capital lah. However, if you look on the technical trend, if you actually zoom out over the long term, over the last couple of years, you can see that 700 is a level that we have hit before and actually came down. So we have actually bounced off that same level again. However, if you were to zoom in a little bit, basically ignore my drawings. If you look at the green line at the bottom here, basically it shows that 550 could be support because we have bounced off there twice. However, my concern is that by the time we reach 550, we might be below the 200-day moving average, which actually will increase the sell pressure on the stock. So I'm not actually very sure what's happening. However, if you already have a position, this is something that you want to start a position in. If you actually see that the stock actually comes down to about the 600, 605 range and bounces off that support and continues the trend, then that is somewhere that you might want to consider your dollar cost average. But if you do not have a position yet, I will not recommend you getting in at $600. That's only for people who already have a position. They just want to continue to add to their position. If you see the support at 600 being tested and validated, then I think it's okay for you to start to deploy a little bit of capital there. But if you do not have a position yet, then I would say that let's just wait a little bit. I don't mind waiting for it to see whether or not it'll hit that support at 550 or even at maybe slightly above 550, 570 along the 200-day moving average. And I think that's where I'll feel a little bit more comfortable if I want to start a completely new position. But like I said previously, if you just look at the fundamentals of the company, they are good, they are not great. I think Netflix has a very strong business. I do like their business, but for the valuations that we are paying, I think that at the moment, there are other companies that might be more attractive to me right now. If you have to look at the expectations, revenue growth, like I said, because it's mid-teens growth, so to pay 39 times earnings, I'm not very sure. And I think why people want to pay 39 times earnings, right, is because their EPS is expected to grow by 58% this year, and then slowing down to somewhere around the mid-teens growth for EPS as well moving forward lah. So that's actually quite significant if they can actually maintain this kind of level of growth rate, and then maybe this 39 times earnings will be worth it. So I'm not discouraging people from buying Netflix. I actually like the company. I like the business. The valuations are okay, not fantastic, but okay. But I do think that I see better opportunities out there. I said I won't be in a hurry to buy if I already have a position and they actually validate support at 600. I'm okay to start to dollar cost average a little bit inside. However, I'm also wary that the market may continue to fall. And then when the market falls, there may be other deals out there, companies like Amazon and all that, which I feel like are a better deal at current prices. So let's wait for the rest of big tech earnings, see how the Nasdaq moves, because it's not cheap, but neither is it massively overvalued. I'm excited about their margin expansion, but I want to look out for their growth in their ad tier subscribers and how they scale their content, because I do want to see them expanding margins meaningfully and actually bring more money down and as free cash flow, returning it to shareholders in the form of more share buybacks and things like that. Because they are already a mature company, growth in terms of revenue is not a super big concern to me, and basically I'll be looking at all these other things moving forward. And that's all for now, and I'll see you in the next one.